Welcome to Passive Income from Alternative Assets to Real Estate and everything in between, and not podcasts. In this show, we discuss litigation, finance, lawsuit funding, and all other alternative assets all the way to real estate assets, including multifamily, student housing, and everything in between. You will get direct insights from operators, investors, team members, so you can better understand opportunities. If you are an active investor, we want you to become better in your own deals. Learn what propels your success and help you get to the next level. If you are a passive investor, we go behind the scenes so you make a better decision with your investments and give you options so you reach financial freedom and make a difference. Please subscribe, leave comments, like, and you can reach at podcast@yourtcp.com. You can find us on YouTube, Town Center Partners. Now your host, Ronnie Elias.
This is Ronnie with Town Center Partners. I have Mr. James Eng. James serves as the Senior Director for Old Capital. Mr. Eng is actively involved in financing commercial real estate with a focus on multifamily in Texas. He has financed over $800 million in multifamily properties, over 125 since 2015. Before joining Old Capital, Mr. Eng underwrote over $750 million worth in loans over 8 years for the acquisition or refinance over at GE Real Estate. Prior to his work at GE Real Estate, he completed GE's financial management program at GE Capital with rotations in Connecticut, Colorado, and Texas across multiple businesses. He received his undergraduate finance degree from the School of Business at University of Texas at Austin. Go Longhorns. And he has invested in 25 multifamily properties totaling over 7,200 units as a limited partner. James, thanks so much for coming on here. It's great to have you.
Yeah, thanks for having me, Ronnie.
All right. Well, first off, to you and your family and anyone watching out, our program today, hopefully you're safe and staying healthy while we kind of deal with this coronavirus that's issue, and hopefully this will pass as quickly as possible. So, James, kind of, you kind of control the money. I mean, you're the biggest partner in the deal. You're the guy.
Yeah, that's absolutely right. I mean, we always tell people we are your biggest partner, and we bring 75 to 80% of the money. And so, I mean, if you want to start off right there, I mean, we can talk about a couple things that are going on in the market that I'm seeing right now is, number one, let's talk about the guys who already own properties, right? So the guys who already own properties, the CARES Act was passed, and essentially Trump said, look, you can't evict anybody for 120 days. And landlords said, that's usually our last, line of defense for people not paying. And, what about us? What if people don't pay? So Fannie and Freddie rolled out two programs, essentially they're pretty close to each other, but essentially both of them said, look, you can forbear your loan for 90 days. Okay. But, you can't evict anybody while you're in forbearance, and you got to pay the money back within 12 months. And everything sounded good about not having to pay for 3 months. But the problem is you got to make up that payment very quickly.
Right.
And so most investors right now, we're recording this in mid-April. They're about, depending on the property class. So Class A properties that I'm invested in, they have about 90% of the rent already. Class B is about 80%. Class C is about 70%. And it's going to take a little bit longer. But April rent collection seems okay, right? So your expenses are typically about 50% on multifamily. And so you're able to cover your expenses. You can probably cover your mortgage payment if you get up to 85, 90%. It really starts hurting if you're only collecting 60% or 70% of your rent. Like in May or June, the government essentially sent out a bunch of money. And if people use it for food, people use it on other things besides rent, then collections are going to go down because unemployment just came out with another record-breaking week, and I think we have close to 17 million unemployed right now. So that's on the people who already own properties, and that's what they're going through right now. Almost every multifamily investor that I'm talking to, they are working on survival and getting through this time frame. The people who, if they are looking at any new deals, any new types of loans, Fannie and Freddie have pulled back in terms of how much leverage, how much IO, how much they're going to give to people right now. And they've also added sort of belt and suspenders, I would call them, and they've put interest reserves. So they have interest reserves of anywhere from 12 to 18 months, Fannie Mae, depending on the loan size. So if your loan's under $6 million, they're saying, I need 18 months of P&I. And if it's over 6 million, 12 months of P&I. Freddie Mac is doing the same thing. They want 12 months principal and interest upfront at close. So just to give you an example, we were looking at a deal here in Dallas. It was about 10 million. Loan was $7 million. Just the reserve. So 12 months P&I, taxes, insurance, replacement reserve. That was about 7-8% of the loan amount. So it's about $500,000 in addition that you would have to raise. So they're cutting back leverage, and you have to put up this interest reserve. So you better be sure that this is a deal and that you're buying something that you want to hold on to for a while, because I don't see a ton of rent growth coming up in the next 6 to 12 months. So you're going to have to hold this thing for a while.
Okay. That was a lot to digest. And and maybe you just told us, hey, hopefully you had, a second plan or you had a lot of money in reserves, because it seems we're going to be in for kind of a hard time with some difficulties ahead.
Yeah, I think news is moving so fast right now, and really we're only in like month one. Right. So if you look at historical recessions going back sort of from 1960s or 1970s all the way today, most recessions were anywhere from 8 months all the way up to 18 months in length. And unemployment was, went up to 7 to 11%. Okay. This one, we're only in month one. So I think we've got at least 7-8 more months of this downturn before we start sort of turning the tide here a little bit. And we probably have to see an end to these large unemployment numbers that we're seeing every week. So the people who have properties, yes, this is a time to really button down. And the one positive is nobody really wants to move right now. And
right.
So the tenant retention at most properties has gone from like 50 to 60% up to probably 80 or 90% because nobody's moving. But it's harder to, the problems that we're seeing right now are really on sort of your Class A stuff that is in lease up. Before you thought you're going to lease up in, 12 to 18 months. Now that's probably extended, to 24 months, 24 to 36 months, my guess is.
So let's talk about April. So, everyone kind of had, different opinions. Someone was going to say, oh man, April was going to be horrible. Or, what, April was so early, we're not going to really feel it. Do you think, is it May and June where you kind of are worried, like, let's see how bad this thing is?
Yeah, it's going to come up in those months. Hopefully the government can get the money out. I think the money is supposed to go out this next couple of weeks on direct deposit in terms of their stimulus payments. And then also unemployment. If people have filed it, some of these guys will make, $1,000 a month or $1,000 a week in some cases. And so I think there'll be money there. It's just that there's no requirement for people to use it on rent. It's before the landlords had the hammer with evictions, and the hammer has been taken away for 4 months. So it's essentially just going to be we need you to pay, and we don't want to mess up your credit, and we don't want to have to kick you out, but we're going to put you in line for evictions, starting, let's say, in August when we can. So,
Right.
I've seen a lot of owners do incentive programs, raffles for people who pay early, people who pay the full amount. They're getting, a gift card to DoorDash or Amazon or something like that to incentivize some of these people to pay, because collections is the name of the game right now.
Let's shift out of multifamily for a quick second and
Sure.
see retail and hotel. Probably, it would be if you're a retail or shopping center owner or hotel owner right now, you are having some major difficulties because tenants are telling you I can't pay, and the hotel is, if you're lucky, you got one room occupied. How do you think?
How do you deal with that? So when I was at GE Capital, we did bridge loans and CMBS loans. On the bridge loans, which are only 3 to 5 years, we had to foreclose in the last recession on hotels. Well, we didn't do a lot of hotels, but essentially office, retail, and industrial. We had to foreclose on all 3 property types. The ones we did not foreclose on were multifamily and self-storage because they stayed full and they could pay their debt service. So even if they had to drop rents, which is what people are having to do right now on the multifamily side, is people are having to drop rents, and they're trying to maintain occupancy. Occupancy might dip as well, but even at 85% occupancy, the multifamily owners can still pay their expenses and pay their debt service. But on the retail side and hotel side, it is essentially shut off overnight for those guys. Right. And what is going to happen is the tenants essentially aren't going to pay, and then the investors are going to have to put up the money. And on some of these larger properties, the general partners on these deals are just going to have to let them go because there is no forbearance. The investors on the other side, like let's say if you did a CMBS loan, the CMBS investor who bought that securitized loan, they still want to get paid.
Right.
And so there's been no program that's been really rolled out on the government side that's given owners of those properties any relief. And so until that happens, there's going to be a lot of pain on that in those sectors. And there was already a gap in cap rates between retail, between hotels, and let's say multifamily, but that gap is getting wider every day until we see some sort of change in that type of property type, which I have not seen yet.
Do you think, if the unfortunate happens, a lot of these shopping centers or hotels have to now start going back to these lenders, that would put some type of pressure on multifamily? Or do you think, hey, it's residential, people still want a place to live, it's going to be somewhat insulated?
Unless those places all of a sudden become places that you can sleep, right? So a lot of these Kmart's and, I'm trying to, like Sears and stuff, I've seen some of those larger retail centers converted to like climate controlled self-storage, right? So unless those all of a sudden become apartments, where Texas is pretty liberal with their zoning, but I wouldn't see where they would allow like a retail strip center all of a sudden to become like an apartment. Right. You know what I mean? I think the zoning is going to have some sort of effect on that. So I think it's just going to be a change of the type of retail, right? So almost all retail transformed from a place where you went to buy something to a place that you went to eat, or more experiential retail, or, a place to go get a haircut or anything like that. Like all that type of retail was still in place and will still be needed. It's just that this particular recession has made any type of going out evaporate. And so I think it's going to take that sector a long time to come back.
Now, you talked about CMBS. So CMBS was pretty popular, I would say, the last couple of years because they were just aggressive. They usually could, get you high leverage, a good rate, and so forth. Now, what's going on with CMBS? Are they kind of out of the game right now, or what?
So there's a lot of volatility in CMBS. The reason being is, so the way CMBS works, essentially, as a lender, you do the loan, you originate the loan, you hold it on your balance sheet for a short amount of time, but then your ultimate goal is to securitize them or put all these loans together and then sell off pieces to investors. And the person in the first loss position is called a B-piece buyer. And that B-piece buyer, if they don't want to buy your stack or your loans, then essentially you as the lender have to hold all those loans on your books. And all these shops are not set up to be able to hold all those loans. And so there's been a lot of volatility in that people are afraid to quote deals, and people don't know if that guy's going to actually close. And the CMBS lenders have sort of pulled back. So until there are securitizations that go through and there's a market for that type of stuff, I think CMBS is going to be on hold for a little bit here, especially for like Fannie and Freddie, the same way that they're worried about collections. I mean, the retail, hotel, any of those CMBS loans that are backed by those types of collateral, which a lot of them are, I mean, people have no idea how bad it's going to be on that side yet. But I think they can forecast it pretty easily.
So this is just between us and the internet. So talking about Fannie and Freddie, do you really think so? You give this lender, like in your example, $500,000 to hold in escrow.
Yep.
And let's say, you went through a year or 2 quarters.
Right.
This is just maybe me. I'm a little bit pessimistic. I think it's going to be very hard for you to call up, hey, I'd like to get that $500,000 back. Do you think?
Yeah, no. I mean, so you sign, essentially when you sign the loan agreement, there's a test that they're going to run. The test is essentially going to be, look, can you, for 2 consecutive quarters, has your property shown a 125 debt service coverage? So it's pretty, I mean, there's some underwriting in that, but it's pretty straightforward on when that's released. So as soon as you show a 125 debt service on, let's say, Fannie Mae loan, then you're going to get the money back. So, I mean, Fannie and Freddie are not trying to really, the reason they're doing these interest reserve escrows is to get through May, June, July, August. They don't know how long that's going to be. So this is their way of saying, if this lasts for a year, I'm covered. Right. So you're essentially just putting it up, and let's say in August, so let's say you close the deal today in April, and then let's say you're fine May, you're fine June, but August for whatever reason is, a 0.7 debt service, and you need that additional, 0.3, you can draw on that reserve. So that reserve is set up to draw upon over the next 12 months if you need it. So if your collections are down, then you can draw upon that reserve as well.
Not try to get into any of the legal stuff, but could that technically be a default, or is it because it's an interest, it's a reserve, you can just draw upon it?
So they have not really, I haven't seen the full sort of amendment to the loan agreement. So they just rolled these out in the last week or so. So I have not closed the loan with the full agreement in there, but the ones that I've seen is essentially, this is like an escrow set up for you, the borrower. It'll be released, after 2 consecutive quarters, and you can draw upon it if you need it. I don't think I don't think you'll be in default though on the loan if you have to draw upon it.
So, in multifamily, the hottest or what everyone always talks about is, I want a value add deal.
Sure.
And, hey, I'm going to buy this 300 unit apartment complex. Rents are, maybe $100 to $200 less. I'm going to put somewhere between possibly $3,000 to $8,000 a door.
Sure.
So if someone called you up today and say, listen, I want to do a value add deal.
Right.
Would your response be, first off, how the hell do you think you're going to push rents 100 or 200 in today's climate? So is value add somewhat on hold and people are going to test your financial projections a lot harder?
Yeah, I think right now it's going to change to what are you buying it? What's the basis in your deal? What are you buying it for? What were rents? And to me, so like, let me try to think of an easy example. Like when I started investing in 2015, most of the deals were 8, 9, 10% cash on cash. Okay. The last couple of years, most deals were maybe 5, 6, 7% cash on cash going in. And so I think it's going to return back to that 8, 9, 10% cash on cash. That's number one. And then people are going to be a lot more conservative on their rent growth in year one. And so they're probably going to use flat rent growth. And then can you still, like, can I buy on today's in place rents and get a 8 to 10% cash on cash amortizing on an amortizing debt? Right. So let's say you come in, the current loan on the property is like 8.5 million. And the person who bought the property, let's say a year ago or 6 months ago, they bought it for 12. And for whatever reason, they need to get out of the deal and they're willing to sell it to you for 10 million. Right. So I feel a little bit better about that basis. I feel a little bit better about coming in with less equity than the last guy. And then as there's probably going to be some sort of problem that is needed to be fixed because on a lot of multifamily properties, what happens is if you don't have enough cash and you start starving your property, all of a sudden you start pulling stuff out of one unit, putting into another unit. And then all of a sudden it's sort of like the downward spiral. Where eventually you drop from 90 to 85 to 80 to 75. And so I think most of the value add, quote unquote, is not going to be taking a property from, $1,000 average rent to $1,200 average rent. It might be taking it from 70% occupancy to 95% occupancy. Versus, so I think it's just going to be a shift in, I don't think your rental rates are going to be driving up 10% year over year. I think it's going to be bringing rents to market and bringing occupancy and bringing paying tenants in versus, like, it might be 95% physically occupied, but it might be 65% economically occupied because everyone's in there, but nobody's paying. So that's a huge difference. And that's what I think people are going to have to come in, and the value add is going to be re-tenanting some of these deals and then bringing up collections is what the value add is going to be. And I think you're going to see some of that if some of these properties hit hard times.
So, for a while, because, everyone wanted to do value add. So sometimes in the beginning, they'll try to start off with a bridge debt.
Sure. Yeah.
That because, hey, their occupancy was going to fluctuate. They needed to do, if you've got 300 units and you're putting $5,000 or $8,000 into rehab, you can't, go into Fannie or Freddie from the beginning.
Right.
And now predominantly, these bridge debts was like 3 + 1 + 1.
Right.
Are you thinking now, just due to this current market we're in, bridge debts, most of these bridge lenders might say, hey, it was nice working with you for 3 years. I don't know if we want to, do another +1 + 1. You might need to kind of figure out how you're going to pay us or give us the keys.
Yeah. As a bridge lender, bridge lenders don't really want to take deals back. All right.
Right.
And so I think most of those +1 + 1 extensions were based on debt service hurdles or debt yield hurdles. And so if your property is performing, they will most likely extend you so that you can either refi or sell the deal. And I guess the question is always going to be, if you took a loan at 80% loan to cost, right, and you put in a ton of money, and now all of a sudden you're 85% loan to cost, but you couldn't get the rents, that's going to be the trouble. Is Fannie's coming in at 70 to 75% LTV on a refi, and you have loan at 85%. So that 10% gap, either you're going to have to raise more money, or there's going to be something's going to have to give to get it refied, or you're just going to have to take a haircut and sell the property and move on to your next project.
Right now, and we're not going to hold you to any of this, but give us kind of a range. Where are we talking? I mean, rates it's been kind of like a roller coaster. I mean, rates
Right.
jumped up, then they came back down. What are we looking at? Just, let's say, 70 or maybe 75% loan to cost. What are we talking about with Fannie and Freddie? And then give us an idea of what floating rate is today.
Okay.
Just a range, so folks can kind of know where things have shifted to.
Yeah, I mean, right when sort of all this hit, the spread. So your interest rate is made up of two things. One is, sort of a base rate, so like a 10-year treasury plus a spread that Fannie and Freddie put on top. And so, 10-year treasury has gone down about 120 basis points this year from the beginning of the year. So it started at like 1.8, it's like 0.6, 0.7 right now. And there was a great time, like in January, in February, when you had a lock spread and then the 10-year kept going down. And so we locked some deals in like the low threes. But Fannie just kept increasing the spread. And, all of a sudden it went from 375 and it popped up all the way to like back up to 5% really quickly. And then now the market's come down a little bit. And so most Fannie deals right now are probably 375 to 4%. And Freddie deals, I would say, is probably 4 to 450, just depending on leverage. But if I was going to model a new deal, to be conservative, I'd probably be at 4.5 to 5%. I think that's really where lenders want to be in terms of comfort level, in terms of interest rate. I just think the interest rates in the threes are just too low. And what Fannie and Freddie, or Fannie for sure, has done is it basically instituted a floor. So the 10-year treasury, they put a floor of 90 basis points compared to, I think it was floating around, it was 0.6 or something like that. And then, so I would say 4.5 to 5 is a good range for people to model deals at. If you, if you're able to get lower, that's just gravy. In terms of floating rate, most people are still pricing off LIBOR, even though it should go away. So LIBOR is like 1%. Most deals on bridge are floating like 400 over that. So you're about 5% all in. And then bridge lenders are also requiring 12-month interest reserve during this time, just because they don't really know what's going to happen. So if you find a deal out there that, occupancy is low already, Fannie and Freddie won't do a new debt deal, you can still take a bridge.
And just out of curiosity, what have you been a fan of? Have you been a fan of floating rate, or have you been, if someone says, hey, I'm unsure about today's market, so I want to put 10-year debt on my property, but hey, everything's for sale. If someone wants to come offer me a good deal, why wouldn't I take it? But I'm sure, when people call you up and say, hey, James, I want to sell this deal, and then you're like, well, hold on, let me run the numbers for you, and you call them back and say, hey, do you know you got like a $2 million or $3 million yield maintenance to sell this thing?
Yeah. So let me start. Any deal probably 1 to 6 million, I would probably do a Freddie SBL loan and get step down prepay. Above 6 million on loan amount, you have to go to Fannie Mae. And with Fannie Mae, really you have to do, if you want 10-year, 12-year fixed money, you have to do yield maintenance. Typically it's too high of a penalty or too high of a cut in proceeds to do step down prepay for loans that size. And so what some people have done is they'll maybe get like a 10-year fixed and then do like a 7-year yield maintenance penalty. And so it's a higher interest rate. It's less leverage. But some people do that. And then some people also on the Fannie side, they'll do what's called a 7/6 ARM, which is a floating rate. It's locked out for 1 year. And then the next 6 years, it's a 1% prepay. So as long as you're able to, but almost every floating rate product they look at, so let's say a 10-year or a 12-year deal was a fixed rate at 4 to 4.5%. Usually your leverage is 75 to 80%, which is what most syndicators want to achieve their returns. On floating rate, they have to account for, even if nobody thinks interest rates are going to go higher, they have to account for if it all of a sudden went from 3.5, which it currently is, up to 7.5, what's your debt service?
Right.
And they still want it to be a 1.0, right? So they're going to stress test that, and your leverage is going to be cut correspondingly. So most floating rate deals, you're at 70% leverage or 65% leverage. And for people who are buying, like I would say Class A, even Class B plus type of product, they don't care. They're not trying to get 80% leverage. They're okay with 65% leverage. So that's where I would say people have started doing more floating rate deals, buying a cap, and then they just deal with the volatility of the interest rate, and then they have a 1% prepay.
So let's talk about that cap, because I think some people get a little bit confused. So, I took the short bus to school. Okay. So, so if I buy this cap, does that mean and it's a 10-year loan, does that mean that my interest is always going to be 4.5 or 5%, or what am I paying when I buy a cap?
Yeah. So let me try to give you an example. Let's just use like we just did a bridge loan probably about 3 or 4 months ago, and essentially it was, let's say it's LIBOR plus 300 basis points. So your all-in rate right now is 4%, and they do some stress tests. The lender does some stress tests and say, look, if your interest rate goes to 5.5, then this deal starts blowing up. You don't have the debt service coverage that we need. Okay.
Right.
So essentially you have to go out and buy a LIBOR cap that says anything above, let's say 2%. Right now LIBOR is 1, but anything above 2, then you're in trouble. So I can't let you I can't let the interest rate go above 2. So you go out to the market and you buy a LIBOR cap for 2% in year 1, maybe 2.5% in year 2, and then 3% in year 3. And if LIBOR ever hits those numbers, then that intermediary or that party will essentially pay your debt service so that your interest rate is capped at that amount. And so it's pretty complicated, but in essence, you have a cap for your interest rate to go to, right? And so the lender is going to calculate that for you typically, and that's what you go out and buy. So this was like let's say it's a $20 million deal, and LIBOR, everybody thinks is essentially going to stay flat before they take it away and they transfer it over. But everyone thinks it's going to stay flat to down. And so LIBOR or interest rate caps right now are actually really cheap. So on a $20 million deal, $20 million loan, it was like $20,000. So it was relatively inexpensive compared to if you had to pay yield maintenance on a fixed rate product on a $20 million loan. It would be, I don't know, $3 million or something like that. So it was just, it's a huge difference.
And does that cap now protect you? You kind of, like you said, you broke it down for us, year 1, year 2, year 3. Does that protect us for all 10 years, or only is protecting me for those first 3 years?
So most of the time people, I'm not aware of people buying caps out that far. Sometimes if you have a longer term, because as you go out further and further, people know less. And so it could be for the first 3 years, it's $20,000, but then year 4 is like $50,000, just year 4.
Wow.
And so what sometimes happens is, like, for the first 2 years, or you buy 3 years, and then for the remaining years, like, you have to just re-up it, and then you just keep extending it. So you might buy, 2 years out or 3 years out. You know what I mean? Like, they're just going to keep requiring you before that. You probably a 12-month before it's even up, you have to go and rebuy the cap or something, just so that the cost is reasonable.
Okay. So right now, the Fed is pumping so much money into the system, and we've got this quantitative easing and so forth. Now we know hey, you're not an economist and you're out there crunching these numbers all day long. But do you worry that there's a possible chance of inflation happening with all this money being pumped into the system?
I would love for there to be inflation. I mean, as a real estate owner, why wouldn't you want inflation? I guess the offset is, I mean, in 2008, 2009, 2010, they pumped probably about $3 trillion into the economy, from what I've read, and inflation has been stuck at 1 or 2%, right? And they've probably pumped 5 to 6 trillion already in stimulus packages for this downturn. But on the offset, I mean, oil's down to $20 a barrel, $25 a barrel.
Right.
So it's a huge deflationary effect. So I just don't know if you're going to see runaway inflation. Here in Dallas, let's say a Class B deal right now is $100 a door, right? Would I love for Class B deals to be $200 a door? Probably. I mean, that means rents would have been driven up. If you can put good debt on it, and I mean, for real estate owners and investors, I mean, inflation helps you a lot more than it hurts you, in my opinion. So even if there is runaway inflation, I don't know what the downside is there, unless you can tell me there's a big downside. But I would rather have inflation than deflation, right? And if I had to pay back all these loans on these properties in a deflationary environment, it'd be very difficult.
So what you've told us now is, listen, we've got to now, if I want to buy a deal, I've got to do at least 12 or 18 months interest reserve. The bank is giving me less money. They're going to extremely stress test my deal and go through it and so forth. So all of these items, less money from the bank, your partner, more money being put aside, that means more than likely your IRRs and your cash on cash is going much lower. That would then make you want to, unless what?
Unless you're buying at a better price.
Exactly. So that means more than likely cap rates have to expand and prices have to come down if you're going to do a new deal today.
In the short term.
Yes.
In the short term. So I think people who, if you have a maturity in 2020 and 2021, or let's say you bought a deal in 2012 and you've held it for 8 years, and you have $5 million in equity, and you're able to, instead of making $5 million, you make $4 million in gain, then you deal with it, right?
Right.
But if you don't have to sell, most sellers are saying, I'm going to wait 12 months, 18 months, or 24 months. And, I think I can get a better price later. And so they're just going to hold their asset.
Right. I mean, well, that's what they're going to have to do, as long as they can keep everything cash flowing for the time being.
Sure. Yeah.
And more than likely telling their investors no distributions for at least, I would think any investor, any owner right now would probably say for the next 3 or 6 months, there are going to be no distributions.
Yeah.
And then we'll take it. So let's talk a hypothetical. Let's say I call you up and say, James, listen, I've got these big wigs from New York. They want to meet with you. They want to pay you for your time and pick your brain. So we walk into this imaginary conference room and they say, James, we have $1 billion worth of cash. We want to buy. We want to be an advantageous multifamily buyer. What do you tell them? Do you tell them, hey, wait a bit, we're just really, like you said, a month into this? Or do you tell them, I don't know how multifamily really is going to get affected? They tell you, listen, we think our seller is the bank. We want to buy, we think a lot of people are going to default, and we're going to be able to go to the bank and say, here's cash on the table, 3-day close, take your money. You've got 100 other loans you probably need to go fight with and deal with. You better take some money and so forth. What advice would you give them or tell them in this hypothetical?
I mean, one of the guys I follow, he said, once I see 2 consecutive quarters of negative GDP, he stops distributions like we talked about. So Q1 is going to be a negative. Q2 of this year will be a negative. Q3 is up in the air, but probably still a negative.
Right.
Q4, Q1, everybody's hoping is a positive GDP. And if you look at historical expansions, almost all of them have, at least 15 to 30 months of positive after you've seen 2 positive quarters of GDP. So that to me is the safest time to come back in. Are there going to be advantageous buys in the next 3 to 6 months? I don't know. We have not seen desperate sellers yet. Most of them so far have been still collecting the rent and still doing fine. And so they are not desperate. Banks haven't taken anything back. Banks haven't even approved people for forbearance, right? So to qualify for forbearance, you have to show that you're at a negative or under a 1.0 debt service. And people haven't been able to do that yet, right? So no one's been even approved for forbearance. So I think it's going to be all right, you're going to do forbearance on this guy. Then after forbearance, he's going to have 12 months to pay the money back. He might not be able to pay the money back for whatever reason. And then you're going to see finally lenders maybe taking back properties in 2021. So I think that's when somebody can come in and buy some of these properties for cash and things like that. But right now, what I'm seeing is just people coming in and assuming loans and taking those positions over and then just bringing in a lot of cash into these deals to support them for a year or 2 before rents increase. So I would say it's too early right now. I would probably give it at least 9 months.
If you start to see a lot of people going into forbearance, I mean, usually, I think what sometimes people miss, if you go into forbearance, usually the next F word is foreclosure. Because I mean, forbearance isn't like a fun place to be. And usually, that banker who kind of, or whoever you are dealing with, the servicer or some, it goes from a jovial conversation to more like, where's my money? What's going on? And the conversations get a little bit different. If you start to see a lot of people electing forbearance, is it your opinion that sends a message, hey, we are going to be in some rough time? Or, they'll go into forbearance and then hopefully it gives them that breathing room to kind of come back. Yeah,
I mean, the hard thing is that let's say you go in forbearance for May, June, and July, and your payment was, I don't know, $25,000 a month. Where does that $75,000 after you come out, where does it come from?
Right.
I mean, essentially, you're not getting it from your renters. So you're going to have to get it from your investors, or you're going to have to build up cash on the backside of the next 12 months. And if you as a property can't do that, then you're in trouble, right? Or you're going to have a capital call, or people are going to have to put in money. And if this runs longer, so right now they're only giving forbearance for 3 months. But if you hit, let's say you have it for May, June, July, and then in August, September, October, you're still not hitting your debt service, you're in trouble. I mean, you're gonna have to pay back your forbearance, and you can't cover your debt. Then that's when people are they're gonna be able to survive for a little bit. Most properties, I would say, have maybe a month of mortgage payment and a month of expenses. Most properties at the property level. So I mean, you're gonna be able to survive a couple months, maybe 3 months, and then you're gonna be in trouble. So I would, start forecasting sort of your worst case scenario. And then, I mean, I talked with, I don't know if you know Gene Trowbridge. We talked about, so what do you do before you do a capital call? And he was like, well, I'd probably start at the general partner level and see what loans are available from the general partnership. then maybe talk to maybe your top, maybe key principals or, large investors in the deal. And then your third and final is really just going to the limited partners and saying, hey guys, we need an extra $5,000 from everybody to maybe fight this through. And I think that last one is a difficult position to be in because people who put in 50 or 100,000, now you're telling them, hey, we need another 5 or 10. I don't know how much of a response you're going to get. So,
well, you'll get a response. It might not be. It might not be a response that you.
We how much of a positive response you're going to get? I don't know. So I think that's where we're going to have to see how good people are on collections, how people manage through this, because during the good times everyone looks like a hero, but this is the time when the asset management, the property management, all that stuff really matters. And so with my top general partners that I work with, we're having almost weekly calls to go through collections, to go through, where they are with expenses, CapEx projects, going through what loans they have currently. Should they be refinancing? Should they be taking forbearances? What's their cash balance on the balance sheet? How much money do the general partners have? All that type of stuff, to make sure they're way ahead of this and to make sure that they don't get to the point where it's too late.
Let's talk about refinance for a second. I mean, if you bought a deal in the last 3 years and let's say you put 70 or 75% LTC, it seems more than likely it might be very hard for you to refinance today because due to the amount of escrows you need to hold. I mean, you might just pretty much break even or pull out a little bit of money, not that much, it seems, if anything.
Yeah, I mean, if 3 years ago you put a 10-year loan on it, I wouldn't refi, right? But if 3 years ago you put a 5, maybe look at it. If it was 3 years ago and you put a 3, I'd definitely be looking at it. So I think it just depends on how much term you have left and what your interest rate is, right? So if you locked in at 4 to 4.5, you're probably not going to get that much better right now. And I'd probably just hold. But if you're at 5 or north of 5 and, you bought the property for 8, now it's worth 12 and there's equity there. And what I've seen some people do is they've sort of refied, but they've only given like maybe half the cash back to the investors and held the other piece. Or on some deals, if it didn't qualify Fannie Freddie and you did a recourse bridge and now you're just trying to get off a recourse right now and just go to non-recourse, I'm doing a couple of those right now where people are just like, hey, I'd rather just sort of reset the term. I got 2 years left on this recourse loan. I don't know how long this is going to go. Let me just put a 7 or 10-year non-recourse Fannie Freddie on it. I'll put up the escrows. I'm fine with that. But I don't want to be held recourse on an $8 million or $7 million loan.
In that 07 to 09 period, sometimes you'd get a phone call and say, hey, my name is John Doe. I'm with XYZ Bank. Your bank pretty much disappeared. Right now banks are, have been killing it for the last couple of years. I mean, they've had great growth, solid profits and so forth. Do you think we might also start to see some issues with some of these banks that were overly aggressive trying to compete with CMBS and all these other players out there in their loan portfolios?
So the reason I don't invest in stocks is I cannot tell what the banks are doing in terms of profitability. There's just too many moving pieces. That's why I invest in multifamily, because I understand the balance sheet and P&L of that property. But what I am seeing, and this is the part that people have requested a bailout, they have not seen the bailout, and sort of goes back to the CMBS stuff that we were talking about, is some of these, I guess you could call servicers, like the delegated underwriters on the Fannie side and Freddie side. Essentially, let's say you don't make your payment for the 3 months for forbearance.
Yeah, okay? These servicers are going to hate your guts because they got paid now.
The servicer pays the payment,
right,
to the investor.
So they become
And
Uncle
on the
Vinny. They're paying for you, and then they gotta collect you.
Yeah. So that's why Fannie and Freddie are saying, look, I'll front you 3 months, but I need the money back in a year, right?
Right.
Or sooner. Get it to me sooner. So that I have not seen a bailout on that. And on the multifamily side, they are being strict on forbearance, but I cannot imagine on the retail, hotel, office side if those deals start going bad, because on like most of the deals that I do, I would say are anywhere from 5 to 15, maybe $20 million loans.
Mm-hmm.
And, these general partners can come together and make those payments. But on these larger office, retail properties, I mean, there's no way no one's making those payments
Right.
to substantiate. So it's just, I don't know what's going to happen to those. I think they're having the same issue on single family, right? So the good thing about multifamily is if someone doesn't pay, that's okay, because I got 90% of the other guys paying. But
Right.
on single family side, if one guy, it's either 100% or 0%. So the guy's either going to pay the mortgage or not pay the mortgage. And I think, and I'm not an expert on single family, I just read a couple articles about how I guess they're given 12 months forbearance, whether or not you have an issue with COVID-19 or not. So if people just stop paying their mortgage for 12 months, then yeah, there's going to be issues on the servicing side. So however that's hooked into the banks, yeah, that could have a ripple effect into the banks if the banks are giving these servicers, lines of credit or what have you.
It almost seems like, hey, we're just going to kick the can down the road, and the can is just getting bigger and bigger, and then you kind of hold out your hands and say, okay, where's all my money now? And at that point, folks are going to be like, well, it was a short period of time, I wasn't able to make it. I guess, when do you want to come pick up the keys?
Yeah, I mean, right now, from the multifamily side, the guys who are holding the bag right now are the investors.
Right. Unfortunately.
Because essentially they're not getting their distributions. Whereas if people aren't paying their rent, the mortgage is still getting paid right now. So right now it's the investors who are just taking on the chin for a little bit.
So putting kind of your investor hat on, let's say May, June, July are not that great. Does that then, change your mindset going forward, saying, hey, you know what, I might start looking at industrial assets, because at least I know Amazon more than likely could pay its landlord rent? Or do you still say, you know what, I think multifamily is still a good asset class. This was just a once in 100 year possibility of happening?
If I knew industrial as well as I knew multifamily, I would invest in industrial, but I don't. The challenge that I have with industrial typically is, number one, it's usually 1, 2, maybe 3 tenants. So it's, if you lose one tenant, you're all of a sudden debt service 0.7 versus. So I just like the diversified income streams, diversified tenant base of multifamily, and you can put up an industrial property in 6 months, I would say. And so I think supply is always going to be an issue. And, just going back to my GE days, there's a lot of deals look great on paper on the industrial side until they didn't. And it can turn very quickly. And, I think there's a lot of competition in an industrial. And I think if I had to decide, would I rather buy a multifamily deal at a 5% cap or an industrial deal with 3 tenants or 2 tenants or 1 tenant, I'd probably still take the multifamily deal.
All right, kind of to try to bring this all together, usually in situations like this where, you have, the economy is going bad, there's usually a 1 punch and a 2 punch. You might be able to, you'll be a little bit dizzy after that first punch, but, that right hook might knock you out. Do you, of course, we all, our crystal balls are all broken, but are you kind of thinking, hey, there might be a second punch coming, whether, who knows, these airlines some of them disappear, or, there's kind of like a massive workforce that, we continue to have, a high unemployment rate, which could be disastrous for a lot of industries. So what's your opinion on that?
I do not have an opinion on that. That is too hard. I mean, I don't know. Do you follow Howard Marks?
I follow him a bit. Yeah.
So he just wrote a great memo. He usually does a memo a quarter. He's put out 4 memos in the last 4 weeks because of so much volatility. And he spoke about how, the market usually has 2 dips like you talked about. And almost the last 10 or 15 recessions, there's been 2 dips. And nobody really knows what it's going to be. But he said, look, you can't, it's impossible to call the bottom on these deals. But what he knows is that the market's down 20-25% in terms of stocks. The stock market is down 20% from where it was in February to today. And so he's buying right now in the stock market. And then if it drops another 20%, he's going to be buying at that point as well, right? And so I think if you're sitting here waiting forever, so if those rich guys from New York come to me and say, look, I need to buy at the absolute bottom. And I'll say, well, you can't know the absolute bottom because it's impossible to foretell. But what I can do is I can buy at a good price relative to the value that I think there's still room, and keep doing that. And you'll buy throughout the down cycle and you will come out fine. And so I think if real estate, whether it's a 6-month or 9-month drop or 6 to 9 months lag behind the stock market, then I think if you find good deals at that time, let's say at the end of this year or beginning of next year, I think you buy and you invest. And then if there's another big drop, I think you invest again. I don't think you call the absolute bottom. I think you invest throughout the cycle. And I think so when I started in 2015, the expansion had been going for 5 years, let's call it. And everyone said, this is the top. So I said, well, I'm going to invest, 1 deal a quarter and just sort of dollar cost average my way into these deals. And I think coming out, I'm going to do the same thing in that, it's not going to be, I'm not going to drop, buy 20 deals in, December of 2020. I'm going to just, probably invest in a deal a quarter coming out of this thing. And I think some deals will do better than others. And you just, Howard Marks talks about the enemy of, I guess, perfection is the enemy of good. And you as an investor don't need to hit a home run on every deal. I just need to hit singles, doubles, triples. But I don't need to hit a home run. I don't need to hit a grand slam. And so if you sit there and wait for everything to be perfect, you're never going to invest.
Do you think the syndication model might change, in this next year? Syndication exploded. Everyone was doing it. The banks were, okay with it. Yeah, hey, just, as long as the numbers work out, and so forth. Is it now going to be, less and less syndicated deals because either just, you've got to put so much cash in, or the bank is just kind of a little bit, kind of gun shy to do deals?
I think the syndication model is going to be similar. I think the biggest difference is going to be your sponsorship group.
Mm-hmm.
So they're going to put a lot more pressure or a lot more credibility in this market. So before, I would say Fannie and Freddie were looking maybe 80% at the property, 20% at the borrower. Now I think it's 50-50, or it might even be more on the borrower. And they're going to look at the borrower and say, all right, how much net worth, how much liquidity does this guy, how much experience? Has they been through this? Have they been through forbearance? Right. And to me, I think this is a time to show Fannie and Freddie that you're for real. So if you bought deals in 18, 19, 20, and you're able to make it through this without taking a forbearance, without calling the lender and, complaining about, hey, my collections are down and I need, 3 months forbearance, or I need 6 months for forbearance. Fannie and Freddie are going to remember that. That's on your record, right?
Right.
But if you said, look, it was a tough time in 2020. I made it through. I didn't call you. We had plenty of money in the bank. We made it through. In 2021, 22, they're going to remember that, and you're going to have 5 years experience, and you're going to be that much of a better operator. So I think if you go through this cycle and get pummeled, your career as a syndicator is probably pretty much over.
Right.
So I think if this downturn is extended, it's going to flush out a lot of syndicators, and only the top guys, good balance sheets, good liquidity, good experience, good operations are going to make it through.
James, it was such a pleasure. You brought so much information to us. And so if people want to get a hold of you, or how could they kind of find you or get a hold of you? What's the best way for them to try to reach out to you?
Yeah. You can start with, you mentioned my YouTube. You just go to, youtube.com/James Eng. That's, you can reach me on my email, jeng@oldcapitallending.com. And then my website is just txmultifamily.com. That has all my closings, all my videos, things like that on it. I'm happy to talk to anybody about, their current deals, or even, deals that they're looking at in terms of refinances or acquisitions. My specialty is multifamily, and, I like investing I sort of put on a lot of different hats. I put on a risk hat, I put on loan originations hat, put on investors hat. So I do a lot of different things. So just, send me an email, give me a call, and we can go from there.
No TikTok. They can't reach out to you on TikTok or Instagram. Nothing like that. Is that another way they could try to follow you? Or
my TikTok is in progress. It's not. It's not public quite yet. I'm still working on that. We've been on lockdown for a month, but it hasn't been that long.
Okay. Well, hey, in a short period of time, you'll be able to find James on TikTok, and he'll be dropping golden nuggets there. James, again, thanks so much for being on here. Stay safe to you and your family and everyone out there. Please continue to, stay safe and healthy, and hopefully we'll all get through this quickly.
Thank you so much for checking out the show. Please make sure to check out our next show. Please like, subscribe, and share. Any questions, please email the show at podcast@yourtcp.com. Check Roni's book about litigation finance on Amazon called Litigation Finance, Funding the Pursuit of Justice. Please visit www.yourtcp.com and check out all of the free resources we have for investing. Stay great, everyone, and continue to do positive work out there, folks.